traders, welcome out to your market roundup for February 7th, 2023. Corey here with you. Nice to be back with you. I missed last week. Joe filled in for me while my family and I were vacationing across Puerto Rico and enjoying nice weather and coming back to a lot of snow. So as always, a quick reminder to make sure that you follow your trading plan, and let's get to it. So as far as the markets, I think last week was really the key point, the key crescendo. I've been saying watch for the exclamation point at the end of this rally, and I think we got it last week. So let's take a look at things together. As you can see today, the markets were strong. Dow up about 0.7%, S&P up over 1%, Nasdaq up 2%. Russell 2000 small caps up about 0.7. Again, oil big day up 4.3, and gold basically flat. So advanced decline line, about 2/3 of all stocks advancing. And right now we've almost got 80% of stocks above their 50-day moving average. And we've got the best possibility for an actual trend that could build. Unfortunately, I've been bullish when it wasn't so obvious. I think I'm going to have to be neutral at least here in the near term, even though things are looking more bullish. I think that's the choppy nature of the markets. On the daily news, Fed Chair Powell says that inflation is moving lower, which is great news, but the job is not done, that they will not hesitate to raise rates as needed, and that they may still need to do more of that. Biden calls for a tax on stock buybacks, and he's going to do a State of the Union. He's going to criticize millionaire, billionaire type of individuals managing institutions, corporations that are doing stock buybacks. Now, if you really dig into what a stock buyback is, it's very similar to a dividend. It's just another way to divide up the profits and use them, and rather than sending them out to shareholders, you'd simply buy back stock. Now, are there some examples of people doing the wrong things with buybacks and maybe kind of manipulating the system and so on? Yes, but that's not the majority. And if you really understand it, buybacks are not evil. But anyway, it will be talked about and it will be bashed tonight. The S&P 500, as you look at price action, the downward trend persists, and we've talked about hitting this downward trend, right? And why do I say the downward trend persists? We've broken through that as expected. Well, I don't think we're out of the bear market, because here's ultimately what I've been talking about is this 5-wave pattern. And you'll notice that within these 5 waves, there's actually more small waves, right? Like here it's a 1, 2, 3, 4, 5, or what have you, A, B, C. Here it's a 1, 2, 3, 4, well, that's probably 3, 4, 5, and then kind of an ABC type, and 1, 2, 3, 4, 5, and then ABC. But this is your big 5-wave pattern. This is the bear market of 2022. And what I've been calling for since mid-December, I stayed bullish throughout this rally here, and then I actually said, no, I'm turning bearish. We're at the trend line. We've got this huge expanded range candle. This is an exclamation point at the end of the sentence. I'm out. And I unloaded bullish trades and added bearish trades right there in early December. And then we sold off pretty hard for a couple of weeks. And why did I get bullish down here? Well, to me, again, this was all part of a bigger ABC. Usually, if you follow Elliott Wave, the ABC correction will normally go back up to around the level of the 4th wave. In addition, market sentiment in mid-December went bonkers. There was record number of equity selling amongst individual investors. Put to call ratios, which I'm going to look at, was skyrocketing, historically high. And I thought a move above this downtrend line would create max pain, max confusion. The fundamentals were improving. Inflation had already started to track lower. And don't lose sight of the fact that, yeah, this was a huge downturn in the markets, and it priced in a lot of the concerns and the risks and so on. So the market's priced that in, and now it's time for a rally. Now, I think I shouldn't say the downtrend persists. I should say the bear market persists. That's a better way of stating it. The downtrend, I've kind of felt like, hey, we're in an uptrend for a while. We'll talk about last Thursday and why that's critical, but basically, you've kind of ABC'd your way back up as expected. I think we got a little exclamation point on Thursday, and I think most of this rally is played out. Now, could we go a little bit higher before we go down? Absolutely. Again, I kind of consider myself more neutral, more going to look for bullish and bearish trades during this phase. I mean, I think I had, for a period of time, I had one bearish trade, and then I added a second in Cigna, and I had like two bearish trades and a whole load of bullish trades. So I was about as bullish as one could possibly get. The NASDAQ, well, I talked about this exclamation point, and it's better seen in the NASDAQ, I feel like. The race began for this rally more back in here. So what we were looking for was a sprint for the finish line. And a sprint for the finish line kind of tells you that the runner is running out of steam, right? When you've run a race, you've expended all of your energy and you're running out of gas. And you're just, as you get to the finish line, you make this final sprint because it's every last ounce of energy you have. And then you just kind of collapse on the other side because you're exhausted. The markets took a sprint last week around just prior to the Apple and Amazon and those sorts of earnings announcements, and you saw the spike in volume that would be correlated with an exhaustion, the big run higher, the gap up, and the sell-off that immediately followed. My guess is that this is ultimately going to trade back down a little bit in the short term. I think that was a pretty good, it wasn't perfect, but I feel like it was somewhat of an exhaustion signal. And again, we've made such a huge run. I just am not as bullish since last Thursday as I have been. That to me was kind of the signal to say, okay, we were right about this rally for the past few weeks. It's worked perfectly. But at some point, the trade is done. The picture that we painted has now played out. And we're going to sign it like Bob Ross, and we're going to move on to something else. So I talked about the put to call ratio, and this is really interesting. This is not something that I watch really closely, but it's sort of like the VIX in terms of being a sentiment gauge. And usually, day to day, I'm not sitting there staring at the VIX going, oh, is it giving us a big signal? But on occasion, the VIX will do something really wacky and abnormal, and it really tells you about market sentiment. How nervous, how bearish are people? Are they extended, too bullish, too bearish? There's an old saying with the VIX, when the VIX is high, it's time to buy, meaning when the VIX is kind of put in its high and looks like it's gone through a big exhaustion, explosive move to the upside, usually it'll have a huge candle like this or something after it's just exploded for weeks on end. And you're like, okay, that's it. That's where people full on panicked, rushed for the exits. When the VIX is high, it's time to buy. That's a buy signal. Well, the put to call ratio is something kind of similar to that, in that when you get abnormal, so it's put to call, meaning when you get abnormal amount of put buying, the reading is really high. There's a lot of puts compared to the number of calls being traded. When you have a really low reading down here, then there's a low number of puts and a high number of calls. So we're actually kind of getting towards a lower reading. We're not in an extreme, but we're certainly getting towards a lower reading, meaning fewer puts and a lot more calls. But look at December. Look at mid-December of last year. This is a 20-year chart. It's the highest reading by far. And it's not just the highest reading, it's twice the next highest. And the next highest reading we had was COVID at the end of March 2020, when people again were just out of their minds bearish, thinking that the world was coming to an end. There's not a better spot on the chart to buy than in late March 2020. Right? There's not a better spot. In early 2016, great spot. In 2008, okay, a great spot to buy when people just, this was like after Lehman, and the markets had cratered. And don't get me wrong, the markets ended up going even a little lower than that into 2009, into the spring of 2009. But again, this was a great short-term signal, and we did rally viciously off of that. And so I saw this reading and just went, people are out of their minds bearishly. The sentiment was so bad that people thought the markets were just about to crack and crater and collapse. And I just didn't see it. In mid-December, I said, I think we're going to create this ABC. And this huge bearish sentiment actually makes a downturn less likely. Now, think about why that is. Why would people loading up on puts make a sell-off less likely? Well, because now they're hedged and protected. If you just own stock and the stock market starts to crack, you might give up on those stocks. You might sell into it. You might get margin call, whatever. There's a lot of selling that can happen. If you own stock plus you own the puts, while your stocks go down, your puts go up in value, you're hedged, you're insured. So by the market being massively insured, it made it less likely for the markets to sell off. In addition, it told you how negative they already were. So people had already sold their stocks and positioned for a downturn. If you think the market's about to crater, you're not going to sit there loaded to the hilt in stocks. You're going to unload, right? And so people had already positioned bearishly, which is what this sentiment shows us. And it shows us that they were loaded up on puts. Now, this was in mid-December. In the options market, the front 2 months are the most heavily traded. That's January and that's February. The January have already expired. Max pain. All of those puts bought in December, in January, wiped away. Premiums gone. February almost gone. We're about a week and a half away. A week and a half from now, all those puts will be wiped away and expire worthless. And that's where the front 2 month options get all the action. Sure, there's a few contracts that trade in the leaps or the 5 month out or the 7, but almost all volume on day to day is in the front 2 months. So when you see massive put buying, what were they buying? They were buying Jan and February. Why is that significant today? Well, because after we get past January 17th, the insurance is gone. The insurance is gone, and now they're loading up on call options. You tell me, is it time to lighten up on the bullish side? Again, I think so. I think the market is now basically unhedged and protected, essentially. Those options are expiring, and it could be a bumpy ride in late February, early March, and so forth. So I don't think there's any reason to panic necessarily, but if you ask me where I think we're going in the coming weeks and months ahead, I think it's going to be choppy, and I think it's going to be lower. And later this year, we're going to see some lower stock prices, and we're going to have to adjust to a market that has to adjust to higher interest rates, to a slowdown in economic conditions, and some things that are there's a lag effect, but they will take effect later this year. That's how I see it. So I think the put to call ratio was a great sentiment gauge. We've talked about it before, but we'll kind of tie a ribbon on this. I've done these market roundups since December, and I've had that bullish view, and it probably got a little boring. Well, here's the good news. I'm not going to keep pounding the table to buy, because I think that investment slash trade idea essentially has run its course. So let's get to the heat map. Big day for energy, but energy is one of those that has traded poorly, and there was a bit of an exclamation point to that trade, and it came in the way of Chevron. When Chevron came out with an announcement of a huge multi-billion-dollar stock buyback program and dividend increase and so on and so forth, that is all what we call quote-unquote good news, right? Any individual listening to that would go, wow, that's great news for Chevron and Chevron shareholders and so on. And the stock did gap up. And what has it done since? It's almost gone down every day since that news. And I'm reminded, I've said this before, that news is just news. It's not good, it's not bad. It's just news, and it's how the market trades on that news that's important. The parable of the Chinese farmer is basically that this Chinese farmer has a horse, and the horse runs away. And the people from the village come and they say, "We're so sorry, we heard the bad news that your horse ran away." And he said, "Well, I don't know if it's good or bad news." And the next day the horse returned, and it had two other horses with it. And the people from the village said, "Congratulations, this is great news. Now you have three horses." And he said, "Well, I don't know if it's good news or bad news." And the next day, his son got on one of those new horses to train it and fell off and broke his back. And the people from the village said, "We're sorry, we heard the bad news." And he said, "I don't know if it's good news or bad news." And then the following day, the leader of the military came to the house to get the son, and he said, "My son broke his back." And the people from the village said, "Oh, we heard the news. What great news. He doesn't have to go into battle. He's out of harm's way." And the Chinese farmer said, "I don't know if it's good news or bad news." And the point being, it's just news, and this idea could go on and on and on, right? What you perceive to be good news could be the worst possible thing for the stock, because it could basically be the final buyers flooding in. And that is your exhaustion, and that is your exclamation point, and that is your opportunity to take profits and either short it or look elsewhere type of thing. And when there's quote unquote bad news, so when I say good or bad news, I say it like the public perceives it to be. The sentiment is that this is bad news. And yet when the stock has really bad news and it trades sharply higher, it's not bad news after all, right? All of a sudden, the final sellers flooded the market with their sell orders. They gave up, and now it has nowhere to go but up, because all of the selling has become exhausted. So as far as the market outlook, we've been bullish. We at this point, the trend, there hasn't really been a trend. If you look at the 20, the 50, and the 200, which has come down like this, they've all been bunched together, which is the definition of kind of trendless, right? And we've basically been at the same real price points for the past while, but there's been some incredible trades. This was a great short down to there. This was a great long up to here. And my guess is a little chop and then some further declines. And I don't know exactly how it will look, but ultimately I'd call myself neutral in the immediate term. So let's look at some possible trades. Occidental Petroleum in this upward advance, you can see this is a channel that has played out on multiple occasions, and the top end of the range is up here, and these are parallel lines, which would suggest that over time you could get up as high as above 80 and so forth. Now this is an energy play. It happens to be my favorite. I've traded Oxy a number of times, really trading this range more than anything else, and it's worked like a charm. So I don't know, it might fail this time, but I'm going to bet on it working. And just a little side note, Oxy is a stock that now Berkshire Hathaway, Warren Buffett's company, has been acquiring the shares aggressively, and they now own over 20% of the stock, which is a key metric, because once you pass that threshold, the probability of you acquiring, or Berkshire specifically acquiring, the entire company really increased. And if they are to acquire the entire company, they're going to pay an extreme higher price. So my guess is that probably will transpire over the next couple of years. I don't know how it's going to trade in the between now and then, but I wouldn't say the probability of it is 80% or anything, but I think the probability of that happening has increased to where I think it's actually gonna occur. I don't know what I would give the odds, 50-50 still or something, but I think it will happen actually. So kind of an interesting, I have that in kind of my back pocket as why I keep trading this to the upside, because I want to be in a bullish position when in fact they do buy out the company. But I keep kind of selling when it gets too high and buying when it's down at the lows. Target has been in a huge range. I wouldn't really buy, I don't really trust the breakout because you've got a lot of overhead resistance, but I'd love to buy sort of the little cup and handle-y type of pattern in this little dip here, and then exit my position on the breakout. I'm not sure the breakout will hold. It wouldn't surprise me if it's a false breakout and it fails, but I think we're going to make a run at it. So it's a little short-term kind of trade idea. If I can get in maybe the low 170s and trade it up above 180 and take my profits above that breakout zone, that would be kind of interesting. And then I've had this one on for a couple of weeks. We highlighted it, I think, the first time right here at 85. And then I'm pretty sure I had it last week on the dip, and I'll just add it again. This is one where I think we're still working our way slowly, but continuing to work our way towards 95. So it's been kind of a fun one for like a diagonal, because it's just a lot of choppiness, but it's still just grinding its way higher. And I suspect it'll kind of keep doing that up towards 95. On the bearish side, I mentioned Chevron. This was a perfect example of quote unquote good news, and it literally set the high. And it wouldn't surprise me if it's not done yet. I would kind of look at this as a potential bearish entry point. It's sort of a pairs trade idea where I'm suggesting long Oxy and short Chevron. Long OXY, bearish on CVX, and I think that's a pretty good pairs trade where I think this should underperform and Oxy should outperform. Call it an inverse cup and handle, or kind of even a descending triangle type of pattern that could start to occur. I would anticipate lower highs being set here and some further downside. And they also put themselves in the crosshair in terms of government, because well, first of all, the government doesn't want energy companies making huge profits. It's something that politicians can grab onto to garner public support. Like, energy companies bad, we're good, that type of idea. And so announcing this huge stock buyback and so on was just putting themselves right there in the crosshairs of, Biden will probably talk about them specifically tonight, for all I know. Lockheed Martin traded up towards the 50-period moving average. And again, this is one where it kind of broke down, and I think has kind of had a deep correction. Wouldn't surprise me if this ends up being choppy, but you've got pretty good, 30, 40 points here down towards, even if this was to start to triangle or something like that. You've got a move down here towards the low 440s from about 468. So I guess that's 25 points or so to the downside. And then last but not least, Newmont Mining. This is an area where I went short GDX and GLD and got stopped out of both of them literally the day before they cracked to the downside. So this is a source of a little bit of frustration for me. So take this one with a grain of salt. I missed that downside move and I was positioned for it, but in the interest of keeping my losses small, I did that, but unfortunately took a small loss instead of a nice big gain on this drop. I think in the case of Newmont, we should have a little bit more of a bounce and then kind of a failure underneath 50. So I may look at that as a new possible trade idea. Hopefully it's not revenge trading, but I can't say entirely it's not, because I did just take a small loss in Newmont recently. Markets are still in a bear market overall. I believe the ABC correction is now fully played out. I consider myself more neutral on the markets at this point. Neutral to bearish, really. Initial jobless claims on Thursday, but really there's nothing on the economic side that stands out. And then on the earnings side, AbbVie, CVS, Disney, Pepsi, Uber, most of those coming out tomorrow on Wednesday seems to be the big day for earnings this week. So we'll leave it there. Thanks everyone for being here. On behalf of Maverick Trading, I'm Corey Halliday. We'll see you next time. Goodbye, everyone.